The U.S. housing market has been dominated by 30-year fixed mortgages for many years. But with mortgage rates climbing to over 5% and home prices reaching an all-time high, some people think this will change. In fact, the Federal Housing Administration, or FHA, has already proposed that mortgages be extended from a 30-year repayment term to 40 years. And now, some experts believe that this could be a way of breaking traditional barriers as a means to get wider acceptance of the idea of having a 40-year mortgage loan. So is having a 40-year mortgage really a bad idea? Well, since I'm in the process of buying my first home, I started to ask myself this same question and did a lot more research around it that I want to share with you today. So in this video, what I want to do is cover, hypothetically, if we saw 40-year mortgages become mainstream, how your monthly payments could change, how that would impact home values, and any risk associated with having a 40-year mortgage, with some math and calculations along the way. So if all that sounds good to you, then all we ever ask is for you to hit the like button for the YouTube algorithm so other people like you can find this video. Stay tuned. Hey there, and if you're new, welcome to our channel. I'm Sean with Life Accounting, the accounting company that helps you save on taxes and build more wealth. And in today's video, it is all about the wealth part because I believe home ownership is the #1 way that most Americans build wealth in 2022. But is it smart to take on a 40-year mortgage in order to do so? Well, that's what we're going to talk about. Now, as always, I'm going to put the timestamps to this video down in the description below so that you can skip to the parts that you want to learn the most about. And before we dive in and I tell you what I think, I want to hear from you, okay? Would you ever consider taking on a 40-year mortgage? I'm really curious, so please tell me down in the comment section below. All right, let's go ahead and dive in with #1, the 40-year mortgage explained. So in 2020, many people lost their jobs or their ability to make income due to lockdowns and had to take mortgage forbearance as a means to stay inside of their current home. So this mortgage forbearance program pretty much allowed people to stop making payments for roughly 6 to 12 months on their mortgages. However, some homeowners have still yet to recover from this loss of income even after taking forbearance, so they're still struggling to make their monthly payments. Well, this is where the FHA stepped in and said, hey, I have an idea. What if we extended the mortgages from 30 years to 40 years? Then everyone could make their payments. So currently, this is something that has been proposed and could become a reality very soon, but only for those who are currently still financially stressed due to the virus. However, with home values surging and at the same time interest rates rising, the market is pricing out buyers and making real estate less affordable. For example, here's a chart comparing the average home price to the median household income in the United States. Okay, the red line represents home values and the black line represents household incomes. And as you can see, for the most part, household income has been aligned with home prices. The one time that it broke away from this trend was in 2004 to 2008, when of course the housing bubble happened. Yet we are starting to see this again in 2022. And that is why it is an attractive option for governments to consider making home prices more affordable through mortgages while avoiding a meltdown, because a 40-year mortgage would definitely lower monthly payments. But let's see by how much with #2, how much your monthly payment would change with a 40-year loan. Now, this part is purely a mathematical conversation, so we'll take a look at 2 hypothetical scenarios. All things are going to be equal, okay? Credit, location, square footage, quality of the home. The only variable would be the loan length. So at home A, we have a typical 30-year fixed mortgage at $500,000 and a 5% interest rate. This will give an estimated $3,184 monthly payment, which includes taxes, insurance, principal, and so on, with a total interest expense of roughly $466,000. So that's home A. On home B, now you would have a 40-year fixed mortgage, again at a $500,000 loan and at a 5% interest rate. And this will give you an estimated monthly payment of $2,911, again, including other typical mortgage costs, with a total interest expense being $657,000. So to sum up all the math, on home A, you would pay $273 more a month than home B, but you would pay $190,000 less in interest than home B as well. So home A is going to give you a lower monthly payment, and home B, you're going to pay more interest long term. So what exactly do we do with all of these calculations and all of this information? Well, let's move on to number 3 and talk about the benefits and the risks of having a 40-year mortgage. So the benefits are pretty obvious, right? Like if you really need a home, like you need more space, or you need more financial predictability, or you're just really ready to settle down in one location in one place, then of course a 40-year mortgage could in theory allow you the ability to afford more and give you more buying options, but it can come at a huge consequence because interest payments alone can cost more than the entire price of the home. But if I had to guess, then I think most people would take a 40-year mortgage over a 30-year mortgage in the same way that someone would take a 30-year mortgage over a 15-year mortgage. But remember to tell me in the comment section below what you would do. Now, in my opinion, a longer mortgage would get in the way of the American dream, because if you want to retire comfortably and achieve financial freedom, then eventually you're going to want to have your expenses be low as possible unless you have large passive streams of income. But with a longer monthly payment, instead, you could still be making payments well into your 70s and 80s, which is well past the typical retirement age. Plus, here's another macro thing at play, okay? One thing I've noticed over the past couple of years is that as things become more affordable, it's actually inflationary, which makes values and prices go up. For example, when interest rates were super low, people could afford to buy more things like homes, and what did home prices do? They shot up. Well, we're on the same track again, where if 40-year mortgages did become widespread, values could shoot up, and we may be in the same predicament that we are in right now. And home prices being high are a big factor because your monthly expenses associated with a home will increase as well, because most property taxes and insurance costs are based on the value of your home. But these costs could make sense with number 4, mortgage loans on rental properties, because the one place where it may, just maybe, make sense to get a 40-year mortgage loan is on a rental real estate property. And this is only, okay, if you have a great property that is in a great area with good people who can become great tenants, because this could allow you to have a long-term tenant base who can sustain your ability to make mortgage payments for the long term, while at the same time having longer monthly payments would mean higher monthly cash flow as passive income as a real estate investor. Now, of course, there are always risks associated with any business, especially real estate investing, because even if you have all those things in place, you have great tenants, great locations, and so on, it doesn't mean that the market can continue that way within a 40-year period. And you could be stuck with paying off mortgages, which is why some people still believe in paying off all their properties as fast as possible as a means to reduce risk and have more home equity. Now, I want to leave you with this very important note, okay? When it comes to buying a home, especially your first home, everything should be up for discussion. Like, you need to be very careful and talk to your spouse about your financial goals, which may include how you plan to retire, or your future medical expenses, or vehicles you may want to purchase one day, or places you may want to go, other family matters, and so on. So it shouldn't be just a one-sided thought process of how can you get the lowest monthly payment, because as you can see, it could make sense in the short term, but come back to bite you in the long term financially. Well, I know that's a little bit different from my usual business and tax videos, so let me know if you enjoyed it. Coming up next, I have 2 more videos that you may enjoy as well. So if you haven't checked those out already, make sure you do, and I'll see you over there.